So welcome back to another episode of Multifamily AP 360 and today's our guest is MC. So with that MC, please go ahead and share a little bit more about yourself.
Yeah, I'm originally from South Africa, so we both cricket a lot, right? Grew up in South Africa during a very interesting time in the country's history. And then I went to school there, studied history, economics, and so forth over there. But I actually got a scholarship playing rugby, not cricket, in South Africa. And that's what brought me to the United States. That's how I came to the United States. I played in a league year for years up until 2007. It was great, city-based league, traveling around, playing different teams. And during that time, I love history and economics and reading and business. So I read Rich Dad Poor Dad, the book, and which my mom gave to me because they were in a lot of they had a lot of financial distress at one point. So she goes, read this book. There's a different path for you here, maybe than that we took, because they just did the normal path, which everybody does, right? Max out your retirement plans, money in the markets, that kind of stuff. And it changed my perspective a lot. I took action within 6 months and I bought my first real estate property. And I put some tenants in it, rented it out, collected the rent, paid the bills, and there was money left over. And I'm like, oh, cash flow, just like in the book, just like in Robert Kiyosaki's book. So that kind of hooked me. And then I was like, how many times can I do this? And then through the rugby network, I actually met someone that was in real estate, and they were huge multifamily real estate owners, their family. And I did a couple of odd jobs. It was difficult because I was traveling all the time playing sports. But I we became good friends. And he said, if you're in town, why don't you just come in and jump in and work for us in the real estate business? You love learning. And then I'm like, yeah, just like in the book, Robert Kiyosaki, the rich work to learn, they don't work for money, right? So I'll go work to learn. So I learned the business from the ground up. I started literally picking up trash on multifamily buildings. Eventually did maintenance, apartment turnovers and turnarounds, fixing it up, was part of construction crews, did some leasing, marketing, got my broker's license eventually. And eventually I managed about 500 units in multifamily. So literally started right from the ground up, which gave me a pretty good idea of what happens in a building. I can drive past a multifamily building and I have an idea what happens during the week, what happens on the weekends, what calls the property managers get. So that was really a gift. But as I was going through my journey, buying real estate and growing my real estate business, I came across first, I reread Rich Dad Poor Dad, which gave me another lesson. The lesson was, hey, all of these liabilities on my balance sheet, those oversimplified financial statements, that's someone else's asset. Whose is that? It's the banks. And then I'm like, man, the banks really have this figured out. We're all just pieces on the board. The banks are the board. And then I came across the work of Nelson Nash, becoming your own banker. And Nelson also always said, look, you got to be in two businesses at the same time. You have to be in the business that you're in. So if you're building your real estate business or you have a product or a service business, be in that business. But the second business that you have to be in is you have to be in the banking business. And that kind of changed it. And I started to implement infinite banking with my real estate investing. And that changed the game completely for me. And in 2015, I started my company, Producers Wealth, where, we set up infinite banking, life insurance policies, and then we coach our clients of how to use their infinite banking policies. I saw a massive opportunity because as a real estate investor, I went to all these meetups. This is before you go to meetup.com and find a meetup or have a great podcast with a meetup. This was like, you remember those freebie newspapers you would pick up at the 7-Elevens and stuff where they had it in there. So anyway, I went to all these meetups and then I started teaching at these meetups, infinite banking with real estate and how I was using it. And every single time I was talking about that, more and more people are like, man, I got to do this too. You got to help me. So that gave me the idea of starting that business, Producers Wealth. And we've been doing that for 10 years. We've helped over 500 families in 50 states. implement infinite banking, and we work with business owners and investors all across the United States. And one more thing is, when I started that business, I was having all these great conversations and with clients because they were doing really cool stuff: multifamily, single family, mobile home parks, gold and silver, all kinds of stuff. And I started to interview them, and then I started to publish the episodes, and that was Cashflow Ninja. And then that show came from that, and that was in 2016, a year after I started my company, Producers Wealth. And that show took on a life of its own, and we were downloaded in over 180 countries millions of times, and it's put fuel on everything that we were already doing and helping us spread the message. So that's what I get up to today too, is still Producers Wealth. That's my main focus. And from time to time, I still publish episodes, not as frequently as I used to, but I still publish some episodes on Cashflow Ninja.
Sure. Thank you very much for sharing that. Are you still active on real estate, multifamily space, or you're focusing on this side?
Yeah, my business is the main focus. Just in the alternative asset space, there's a lot of moving pieces, right? And it's just not, I lump everybody into the same kind of bucket, but it's not. There's a lot of smaller buckets in that big bucket. But interest rates, operational costs, there's been a lot of impact on a lot of these asset classes. That's where liquidity comes in, right? If you have an issue with multifamily, you need liquidity to save an asset, to fix an asset, and to eventually exit an asset. So our folks has been supporting people in the alternative asset space. So whether it's multifamily, whether it's all kinds of different assets, our clients are in there, and we help to make sure that they have the liquidity in times of need, because obviously the one side is there's a lot of deals that have gone bad. The other flip side is because there's a lot of opportunities for people to buy deals.
Yeah, yeah, got it. So let's jump into infinite banking. So what is infinite banking?
Infinite banking is basically when you become your own banker in a strategy where you utilize and leverage life insurance. Now, when I say that word, it's almost like a 4-letter word. People are like, what, life insurance? It's almost like they want to run away, because the average person thinks about life insurance and they think somebody has to die in order for someone else to benefit. And the way that life insurance is sold generally in the public at retail level is terrible. High pressure sales tactics, policies not structured correctly, massive commissions for the agent, all that kind of stuff. But the strategy that I've used for almost 2 decades now, and that we help our clients with, we utilize a very specifically designed policy. It's designed like they do in family offices. Now, the average person sees life insurance as insurance. The wealthy and in family offices, the ultra affluent see life insurance as an asset class, just like real estate. Why? Because it is an asset class. It's an asset. It's actually pretty much the exact same asset as real estate. It just has different collateral. You have a building versus a person. It's the same kind of structured asset class. And I'll get to that in a second. But so how do we implement infinite banking? So you use a dividend-paying whole life insurance policy with a mutual life insurance carrier.
Yeah.
And it's structured as a supercharged savings account. So you set up the policy, you put money into it, and usually 70 to 80% of the premiums go straight towards cash value. Then you can access that money at any given point in time. The money is there, of course, guaranteed to grow, tax-free, and you get dividends as a shareholder from a mutual life insurance company. So you get all those wonderful things. Your death benefit goes tax-free to your beneficiaries and so forth. But you can also access the money, like I said, at any given point in time without paying taxes. So how do you do that? Through a policy loan. So let's just say you have $100,000 in a life insurance policy that you set up. Supercharged savings account. The money's in there, growing tax-free. And you then take a policy loan. Let's just say you want $50K. Take a policy loan for $50K. And let's just say it's at 5%. You earn 6% dividends in the policy. You then take that $50K at 5% and you can invest that into real estate that's paying you 15 to 20%. And then the cash flow from the real estate, you then use to pay back down your policy loan. Now, the beautiful thing that happens here is you never actually touch the money in the policy because you do it through a policy loan. That's how you become your own banker. You don't have to go to the bank now for money to grow your real estate portfolio and manage your real estate portfolio. You build up your own liquidity pool with this life insurance policy that you then use to fund and fuel your real estate investments. I had a mentor do this 25 years ago, a guy in one of these meetups. He said to me, here's what we did when I was young. In the 70s, when he was very active, he would take $100,000 and go to a bank. And he would put that $100,000 in a CD. People fall off their chairs when I tell them this. Why? Because the CD paid him like 10%, right? This is back in the 70s. He would go back to that same bank then and say, tell the banker, hey, Mr. Banker, I have $100,000 in a CD with your bank. Can I get a loan secured by that CD? And the banker's, yes, you can. And he'll give it to you at a lower rate, let's just say 8%, right? Or 9%. Why? Because they have your money. That's why. There's less risk for them. He's already got your 100K, that's earning 10%. So he's giving you a loan, 90% LTV, 90K, here you go at 9%. He would then take that money and go buy real estate with it and then pay back that loan. So his money's growing in the CD uninterrupted. And then he used it to buy real estate. That's what you do with life insurance. You just switch the vehicle, what you're doing it with. So instead of using a CD at a bank, which is a savings vehicle, you use another savings vehicle, you use life insurance, because you'll never pay taxes on the growth inside of that bucket. You can access it at any time through a policy loan, just like he did with a secured line of credit. And you could do the exact same thing that way with just more benefits. So that's infinite banking. You become the banker. And the more you grow the system, it starts with you. It could be your wife. It could be your children. The next thing you know, your trust owns all the policies. The trust is the lender to your business, to you to grow your multifamily portfolio. It's a pretty powerful system. And this is what the Rockefellers do. This is what all these other families do. They have their own quote unquote family bank that funds their and fuels their business and funds and fuels their investment portfolio.
Got it. Thank you very much. So, what is the minimum amount the client can invest? How much the value of the insurance policy? And how soon they can access this capital or whatever they loan?
So you're saying, let me just get the question. So you're saying, how can they access the cash value?
Yes. So my first question is like what is the minimum amount they can buy this insurance policy? And what is the worth of that insurance policy? How soon they can access this loan?
Okay, yeah. So minimum, it's probably $10,000 a year. You shouldn't be doing anything less than that. A lot of our clients do 25 to 50K per year. Let's just say on a 50K, you're probably going to have around 35 to 40K available 30 days after you put in 50K that you can borrow against. This ties into people like, what's the negative? It takes time. There's a build-up phase, the first 5 to 7 years, and then eventually you'll have more money in the policy than what you've put in. Using that example, 10 years in, you probably have around, I don't know, $550,000, depending on your age, your underwriting, all that kind of stuff, and you would have put in 500K. But you have that 550 in there tax-free with a death benefit. So that's how those are structured.
Got it. So is there any drawbacks with this infinite banking stuff?
Any drawbacks? It's not get rich quick. That's why I wrote a book called Get Wealthy for Sure.
Yeah.
So it's not get rich quick. It's not a meme coin. It's not a doggy coin. You're going to have to be disciplined. You're going to have to, it's a system that you follow for the rest of your life. It's like a saving system. Everybody should have a system. You just now have a saving system and you're utilizing infinite banking for this saving system.
Got it. Yeah. Thank you. And what are the 5 pillars of family office and how can you create your own family office wealth strategy like the Rockefellers?
Oh, yeah, great. I love talking about that.
Yeah.
I could talk about that for hours. But in short, The 5 pillars and family office, if you like this message, what I'm saying, and I cover this in Get Wealthy for sure too. Family offices are private wealth management companies for wealthy people. If you have 100 million bucks and up, this is what they do. Now, here's the beauty. You don't have to be a Rockefeller to do what the Rockefellers do. You don't have to have $100 million to do what they do. You could do the same thing. The first pillar is legacy assets. This is where you could have your family statement of purpose, which is like the why you're doing all of it. It's almost like the Declaration of Independence, right? For the United States. It's the why. Then you have the family constitution, which is the how, just like how the US Constitution is the how. You could have that structured and set up. You could have your family core values and principles, who you are, who you're not, what you stand for, what you stand against. All that stuff could be in your family legacy assets and family heirlooms and all that kind of stuff. That's the first piece. And that's actually the most important part, because if you don't know who you are and where you're going, nothing else matters. The second piece is legal, insurance, and tax structures. So once you figure out who you are and where you want to go and what your vision is for your family, like all these families do, you can now create legal structures to facilitate that. This is actually the easier part. The same thing with tax structures, minimizing taxes, and then of course insurance structures to protect you and your family. The third piece is the family bank. It's when you build these banking policies, what I just talked about, where all the family members have these policies. When a kid's born into the Rockefeller family, they put a life insurance policy on them. And this is all part of their family bank. Family members can access the family bank for education, starting businesses, real estate, that kind of stuff. And then the fourth piece is asset management. These families think in terms of 100 years. I interviewed Jim Rogers, and Jim Rogers said to me, he said, MC, if you can only make 2 or 3 investments your entire life, what would they be? And I'm like, what? 2 to 3 investments? And he goes, yeah, that's how wealthy people think. Like, they don't chase every shiny object. They look at it and go, I'm going to buy multifamily and blocks of it in Manhattan, in New York City, because guess what? In my lifetime, that will probably be one of the best investments. But in my children's lifetime, my children's children, my children's children, it's going to be there forever. So that would be obviously one thing that I want to invest in. And he practices what he preaches. Think about Jim Rogers. He's the Mr. Commodity. He has the Rogers Commodity Index. Why? It's one of the 2 to 3 investments he's going to make in his life. It's in commodities, because people are going to eat. People are always going to buy commodities back and forth. With his vision, it doesn't matter if I'm in my lifetime, my children's lifetime, my grandchildren, my great-grandchildren, it doesn't matter. They're going to need commodities, always. So that's asset management. That's number 4. And then number 5 is the family mastermind. There's a book, The 5 Men from Frankfurt. It's based on the Rothschilds. And basically what they do is they have a family mastermind every year. And this was, we're talking a couple of 100 years ago, because he sent his sons to all the power centers of Europe, right? All the financial centers, London, Paris. And then they would all get together and be in alignment of the statement of purpose of the family constitution, the family values, who they are, who they're not, what they stand for, what they stand against. Review all that stuff in alignment, and they would best practice. Keep all of the learnings and the intellectual capital inside of the family. So those are the 5 things. And some of those things don't even cost you money. So your listeners can start doing that today. If you want to build a family wealth management business, which every family should have, you don't need to be a Rockefeller to do what they do. Those are the 5 things that you could start working on. And by the way, this takes time. I practice what I preach. I've built this stuff myself. It's taken me years, and it's not even to completion yet. I'm still building pieces of it out.
Yeah.
So you're going to get some stuff that's going to be done quicker than other stuff, but it's going to take you a while to get it done.
If they want to start, where exactly they need to start?
Yeah, if you wanted to start, the first thing that I would do, and I'm giving away a book for your audience, is go to getwealthyforsure.com. Getwealthyforsure.com. When you go to that page, you can download a free ebook and a free audiobook. I thought about you because you're listening to podcasts, so you probably want to listen more to the book than just read it. So you can download that free book at getwealthyforsure.com, ebook and audio. And then there's also a link on that page with videos as case studies. And if you want to book a call with myself or my team, feel free to schedule a call there to explore strategies for you. But that's where I would start. I'd start with the education and then start implementing these things. So to do that, just go to getwealthyforsure.com.
Awesome. And where can business owners get the best returns?
Where can business owners get the best returns?
Yeah.
In your own business. In your own business. So one of the things that I love about infinite banking is if you're a business owner and you're an investor, right? You should be diversified. And sometimes, not sometimes, most of the time, 80 to 90% of your net worth is in your business. Whether it's a product or a service business, or whether it's a real estate business. So you need some diversification, but when you diversify, what does financial advisors tell you? What do they tell you to do? Give me the money, I'll put it in stocks, bonds, and mutual funds, and then you're diversified. And it's like, now you just invested in someone else's business, and you're getting you gave up all control, you're investing in someone else's business, and you're earning 8%? That's lame. If you're running a business, that you're getting much bigger returns in your own business. But how do you still diversify? And that's where infinite banking comes in. Infinite Bank set up this banking business, which is now it's a business, and you become the lender to yourself. It's now diversified. It's no longer inside of your business or inside of your real estate business. It's outside of that. So it's diversified, but you never gave up control, and you always still have access to money.
Awesome. Yeah, thank you very much. So let's jump into some personal side. Before that, like, what's your take on current market? So from real estate or investing point of view overall.
We had a couple of months ago, everything was at all-time highs. Everything. You can't make this up, by the way. Everything, whether it's the stock market, whether it's the crypto market, gold and silver, whether it's the real estate market, everything was at all-time highs. And I'm going to spoiler alert, I'm going to spill the beans here. It doesn't last forever. Markets go up, they go down, they go sideways. Good investors make money in markets that go down, markets that go sideways, and markets that go up. So there's, how I look at it is all the markets, you're going to see pullback everywhere because that's how market cycles work. There's going to be a liquidity squeeze in the economy. We're already starting to see this. I told people probably 2-3 months ago when everybody was reaching out to me about crypto, don't buy crypto. Don't buy them at all. And they're like, what are you talking about? It's like 120,000. I said, exactly. You were the person that told me you didn't want to buy it at 15. Now you want to buy it at 120. How does that make sense? And I'm like, no, you're probably going to hit your peak in October, and then that stuff's going to come down and crash severely. I could see it run all the way down to 50K again. Maybe even crypto is severe, right? In severe liquidity, Bitcoin could even go lower. So why am I talking about crypto? That's the most sensitive to liquidity squeezes. The stock market's the same, and then eventually real estate's the same thing with higher interest rates, operational costs, and liquidity. I can see a contraction everywhere, and that's going to be a great opportunity for people to go out and buy assets at a discount. I'm building on a shopping list. Everybody should build a shopping list. If you're a real estate investor, figure out the market that you want to be in, figure out exactly what you want to own, and start to keep an eye on the buildings that you want to own eventually, because you will be able to. There are some really good investors that would survive any downturn, and then there's other folks that they're going to go washed out, just like every cycle.
Yeah, cool. So any factors that influenced your success?
I would say it's just never giving up. It sounds cliche, but That's the difference between all the successful people I know and the people that are not successful. Because everybody's going to fail and fail a lot and keep failing. And eventually, who are the people that make it versus the people that don't? It's just the people that don't give up.
Yeah, awesome. That's awesome. So, any books, any recent books that impacted you?
It's funny. I've been just doing a lot of my own stuff and reading, like writing and reading and editing my own stuff.
Yeah.
But I will say this. Sometimes you don't even have to read a ton of books. You just have to read the right ones, and you can read them many times. So I reread Robert Kiyosaki's Rich Dad Poor Dad every year. And I read, I think about 2 or 3 times I've read The Creature from Jekyll Island. It's probably a good time to read that one again because everything he covered in that book is what's happening right now.
Yeah, yeah. Good, good. And how can listeners can connect with you, MC?
Yeah, I'm active on social media. They could just look up MC Laubscher. Grab your free book at getwealthyforsure.com, and producerswealth.com is my company, and my podcast they can find on all the other platforms, Cashflow Ninja.
Awesome. And thank you very much. Really appreciate it.
Thank you. Appreciate having me on.
Sure, sure.